The Western world is known to be built around the capitalist model, where the free market played a fundamental role in driving economic growth and innovation. This model meant that there would be private ownership, competition, and minimal government intervention. This model has been a big reason for the unprecedented levels of wealth generation and technological advancements seen in the United States. But this model isn't what is applied to the world's second largest economy, which is known as China. China has a unique model that has worked for its economy, yet did not apply this same free market principles as the West. Instead, China follows a state-controlled capitalist model, where the government plays a major role in guiding industries, controlling key sectors, and setting economic policies. This blend of central planning and market forces has fueled China's rapid growth, making it the world's second-largest economy. To show you just how impactful China's government has been to their economy as compared to the United States, let's graph out the contribution of their state-owned enterprise to GDP. In case you're not aware of what state-owned enterprises are, they are basically companies that are either fully or partially owned by the government. Here's a graph on a dataset published by the World Bank. Here it shows the value added of the industry sector, which is an important sector, as it is composed of manufacturing, construction, mining, and utilities, critical industries that drive economic growth and development. Here, you can see that the value added of this sector in 2017 was 27.8 trillion Chinese yuan, or about $3.83 trillion, of which, however, the state-owned enterprises contribute 5.87 trillion yuan, or $808 billion. That's actually an insanely high figure, as it is 21.1% of China's total industrial sector for that very year. In total, however, if we include major sectors ranging from real estate to the agriculture industry, and a long list of other sectors, we get to see that the value added of China for 2017 is over 82 trillion Chinese yuan, or about 12 trillion USD at the 2017 exchange rate. Of this, however, the state-owned enterprises of China contribute over 22.5 trillion Chinese yuan, or about 3.3 trillion USD at the 2017 exchange rate. This means that SOEs contributed approximately 27.4% of China's total GDP that year. That is no small figure, especially if we compare it to the United States. Unfortunately, data that showcases the contribution of US state-owned enterprises to the economy is minimal, and that is a given because there aren't really a lot of state-owned enterprises in the United States. What drives the US economy is no other than the private sector. But to just give you a clue as to how this works, let's graph out the largest Chinese companies by revenue and compare it to the United States. This works best because many of China's largest companies are state-owned enterprises, whereas in the United States, the biggest corporations are almost entirely privately owned. By looking at revenue figures, we can see just how dominant SOEs are in China's economy compared to the US. Here, you can see that the largest Chinese companies by revenues are mostly state-owned companies. Sinopec, the largest on the list, is a state-owned oil and gas giant. Similarly, PetroChina, China State Construction Engineering, and China Railway Group are all state-owned companies. Only Jingdong Mall, Alibaba, and Ping An Insurance aren't state-owned. In other words, 7 out of the 10 largest companies by revenue in China's publicly registered companies are owned by the Chinese government. In contrast, if we take a look at the largest companies in the United States by revenue, we get to see that not a single company on the list is owned by the American government. Even if we extend this to the top 100th list of largest companies in America by revenue, we would probably still not see a single government-owned company. Now, secondly, there's also another important way that the Chinese government controls their economy, and that is through fiscal policy. Fiscal policy is basically how a government spends money and collects revenue, taxes, to influence economic growth, employment, and inflation. In China, fiscal policy plays a crucial role in guiding economic development, as the government actively uses it to stimulate growth, direct investment, and maintain stability. It is one of the reasons why China's infrastructure has continuously been seeing rapid improvement every single year. And that's because the Chinese government has been heavily investing in infrastructure as a key driver of economic growth. Unlike in Western countries, where infrastructure projects are often debated and delayed due to political and regulatory hurdles, China's centralized decision-making allows for rapid project approvals and large-scale investments. To show you how this works, let's graph out the investment in inland and transport infrastructure for 2020, comparing China to many major Western economies. Here you can see that China stands out amongst these major economies. You can see that even Japan, which is well regarded for its infrastructure investments, is far below that of China. And that is again a given because of the different economic models and government prioritizations. You can also compare the two economies directly when we check their gross fixed capital formation to GDP, which is an indicator that showcases how much of a country's GDP is being reinvested into infrastructure, machinery, equipment, and other productive assets rather than being spent on consumption. Here you can see that China's gross fixed capital formation to GDP has historically been much higher than the United States. This is true even if we look at the data back in the 1970s. Again, as we continuously mention throughout the video, this is because of China's government, which directs their state-owned enterprises to build infrastructure, and as well as guides private investment through policy incentives, subsidies, and government-backed financing. Now that we have an understanding of how China controls its economy, we must understand whether this is sustainable. The question arises because there have been several nations historically, and even contemporary ones, that saw a state-guided boom and then into bust. For instance, at the start, China once had a command economy modeled after the Soviet Union. The Soviet Union had maintained rigid central planning, with little market reform right up to its collapse in 1991. And for decades, the Soviet Union had achieved industrial growth by brute force allocation. But eventually, the inefficiencies of central planning stagnated the economy. Many scholars noted that the Soviet model promoted excess centralization, vast amounts of inefficiencies and faulty priorities, which prevented resources from going to their best uses. Hence, if we were to compare the GDP of the Soviet Union to the United States, we get to see that the US and the Soviet Union had similar trajectory, which was an upwards of GDP growth. But eventually, as the American economy was reliant on the private sector, whilst the Soviet Union on the government, the different models saw one of them go bust, leading to its downfall. But it is wrong to compare China directly to the Soviet Union. As a matter of fact, China actually learned from this experience. In the 1980s, Deng Xiaoping, the former president of China, had explicitly avoided the Soviet path by introducing market forces. Unlike the Soviet Union, China allowed a large private sector to emerge and pursued growth through global trade. This has given China far more dynamism. But what stayed in China's economic model is the state's heavy involvement in key industries and strategic economic planning. While Deng Xiaoping's reforms introduced capitalism into China's socialist system, the government never fully let go of its control over the economy. Instead, China adopted a hybrid model, state capitalism, where private enterprise exists, but the government maintains strong influence over strategic sectors. Beyond the Soviet Union, there's another country that one can compare to China, and that is Japan. Japan also saw a government-guided development through industrial policy and close coordination with banks and industry. This success led to Japan's rapid economic development. But in the 1990s, a bubble burst which saw Japan entering a period of deflation, also known as the lost decades. And what's worrying about this is the fact that China is similar to Japan's economic developmental history. The two economies both had extremely high investment rates, rapid credit growth, and real estate booms leading up to their inflection points. In Japan's case, the overinvestment led to debt-laden corporations and banks holding piles of bad loans, while consumers retrenched. Today, many analysts actually see similar symptoms in China: rising debt, property bubbles, zombie companies kept alive by endless loans, and weak consumer demand. China's debt buildup and heavy state intervention in the economy echo some aspects of Japan's story. However, there are also differences. China is still a lower-income country with more catch-up potential than Japan had in 1990, and Chinese authorities arguably have more direct control to address problems. But that is still the question for many today, and which is what leads us to conclude whether China can keep controlling its economy indefinitely without encountering a major crisis or stagnation. Some evidence suggests that there are growing risks that could undermine the efficacy of state control over time. Key challenges include inefficiencies in the state sector, escalating debt burdens, and external pressures that constrain China's policy options. But anyway, do let us know what you think. Thanks for watching.